Join me now for a conversation with analyst, investor, and newsletter writer David Morgan. His website is TheMorganReport.com. And as we often do, today we'll discuss recent developments in the gold and silver markets. David, welcome back to the program.
Ellis, it's great to be back.
And I want to thank you. I recently took advantage of an alert that automatically became available, popped up on my screen. I want to thank you for that just before you took your latest trip. Your software works when you're not even around anywhere. Let's clue our audience in about the alert service related to the Morgan Report for those that are not subscribers right now.
Sure, members of the website. My webmaster wrote a widget or software for a widget that's an alert system. So whenever I have something that I'm doing, like a trade that I put on here recently, it's working out very well, or in a company alert, we just sent one of those out as well. It kind of saves the member a little bit of hassle. I mean, it pops up on their screen so they can see it. It was a trade that I did just before I popped on an airplane. In fact, I actually placed the order when I was at the airport, but I outlined what I was doing before I left the office. So it's something that, we provide. I don't know how many in the industry do this, and I don't know how many industry do what I do, which means that I do both, the commodity side or the trading side and the investing side, look at both the commodity side and also the equity side. Most newsletter writers look at the equity side only, and we do both.
Clearly there's a lot going on in the market, and I'm sure I'm not the first journalist to ask you this question. Are we in the big gold rush, silver rush that you've been speaking about for years now, that when finally everybody catches on, it's going to go crazy?
I think we are. I want to elaborate on that answer. It's actually what we put out for our free list. There's a lot of free information. We put out an e-letter every weekend. It's usually written by me, but there's contributors. Both David and Chris and others contribute. And that was the question, David, is this finally it? And I answered, I have it right in front of me, but I certainly remember what I wrote. And I basically said that, as far as I could tell, we're in. But I want to be careful because, I'm one that admits errors. And I called that 1817 low, that spike low, and that was right. I was correct, 14 months. And then, of course, we broke through that, and we've been lower than that, and we still are. So I said that there are many, my associates, colleagues in the peer group, whatever you want to call it, that think that there's one more low ahead of us. I don't. I think that the bottom was in November of last year, and I think it's going to be it. Time will tell. We have had such a nice, strong move up, and then again, this trade that I put on where the members looked over my shoulder to see what I was doing has worked out quite well, and these are short-term situations, obviously. That can turn long. Nothing makes me happier than getting a trade position that lasts for, 6 months. When I traded the breakout in silver in 2010-11, I got in at 19, rode it all the way to 48. I exited and entered one time during that whole run. So those are the kind of moves you'd love to do. I don't think we're there on this particular move, although I do think we have probably a couple months, maybe all the way in the summer, for more positive metal prices than negative. So, Ellis, the long answer is we're there. If we are going to a new low before the next move, I don't see it. I don't see how it can happen, but I can't rule it out totally.
When you spoke in previous years about the next bull market, you framed it as the last bull market. Is this the last one we're going to see?
Maybe I did. I think what I meant was that most markets go in three phases, and this goes back to the basic Elliott wave theory, but you don't even have to know anything about Elliott wave. But usually step back and look at markets. They go from undervalued to fair valued to overvalued. But they're not a straight rocket ship from undervalued to overvalued. And in the process, you get a wave that goes undervalued to, maybe fair valued. And then there's a backing and filling, and then you get another move up, and then you get a big correction wave, and then you get what's called a third wave. And that's the one that's the biggest, the longest, and the most lucrative to people that understand markets. You can look at a stock market, you look at a commodity, you look at a particular stock. Does it happen 100% of the time? No, but it happens very, very often, especially on big markets like the stock market generally or a commodities market. So we have ahead of us, I think, the biggest move into precious metals on a percentage basis probably ever. And if you look at the third wave or the last wave or the most productive wave or the most lucrative wave last time in gold, what you saw was the run up to like the $200 level and then the correction to 100. And, if you bought it at 100 and watched it go to 200 and doubled your money and then held it all the way down to 100, you were pretty upset. Or another example might be you got in at, the $150 level, watched it go to 200 and watched it go to 100 and pretty upset. Your you have a paper loss. And of course, it bottomed. And then it went from 100 to 800 rather rapidly, and had a similar chart pattern. So that move from the 100 level to 800 level, almost 900, 850, was significant. And if you caught most of that, you did very, very well. So that's what I'm talking about. This time, that, let's say, 8-fold move could be a 10 or 20-fold move. So if you took the breakout, or you took the low of, let's call it, hasn't been 1,000, but if we did it at 1,000, you did a 10 bagger, you'd be looking at $10,000 gold. No, I'm not predicting 10,000. I mean, guys out there that have predicted 10, people have gone 20, 25, 30. I mean, I think 50,000's out there in the internet blogosphere. I'm not too concerned about what the final price is. I'm more wanting to give the idea to everyone that the biggest, longest, most lucrative part of the market is ahead of us. So if you take that as a gold situation where you could go, let's say, 10-fold, and you looked at silver, silver will probably outperform gold 2 or 3-fold, meaning that instead of going up 10 in that example, again, I'm giving the idea, not the exactness, because no one knows the future, including yours truly. But if we went from silver and we went from, let's say, the, call it $13 level, and you went up 10, you're at 130, and if you doubled that, so it's a 20 bagger, you're looking at 260. Now, does that mean we have to go to $260 an ounce silver? No. What it means is that both of these have tons of room to the upside. Secondly, these markets will go up with even the most ardent bulls not believing they're still going higher. But we had a taste of that already in gold just this week, where we saw almost a $60 move in gold in a day. I mean, we haven't had a day like that in gold in a long time. In fact, I have to go back to the charts and look from the 1970s through the peak in 1980 in January and see if there was a $60 day. I actually don't remember one, but I'm going from a pretty long-term memory. So, Ellis, the deal is this. It's underloved. It's undervalued. Very few are in the market. Many that were in the market have given up. Many will not return. And some that are skeptical will get out and watch it run away from them. So going back to what I was talking about a moment ago, there were those that, let's say, bought gold at 150, watch it go to 200, it went to 100, and then as it went from 100 back to the 850 level, as it passed through the 150 level, they got out. And then when it went to the 200 level, many thought that was a double top, and, oh, that feels so grateful. They bought it at 200, and here it is again. They could sell for no loss. Well, there's a loss because of the interest value of money, but let's just say they felt good, they broke even. But how would you feel if you were, convinced philosophically that gold was a good investment or a good hedge or insurance or whatever word you want to connotate with gold, and you bought it at, let's say, near the $200 level, and you watched it go to 100 and you got out at 200 and you were bragging to everybody how great it was you didn't take a loss in your gold position, and then in a matter of months it's 800, how foolish would you feel? But this is what happens in markets. People get disgusted, they get fed up, they feel that they were right and the market was wrong, and so therefore, when things start moving their direction and they feel relief, that psychological, boy, finally it's back to this level and I'm even and I didn't lose anything. And these are psychological factors that are very difficult for a lot of people to overcome. But really, you have to look at the reason you own gold, and you have to have the right amount. And there is no set right amount for everybody because everyone's different. I mean, you look at my friend Mike Maloney, he's basically all in. What I recommend for most people is about a 10% holding is probably sufficient for most people. Maybe 20% if you've really gotten bitten by the gold and silver bugs. But more than that, certainly you could, and there are those I certainly know that are, but that doesn't necessarily serve everybody the best. So word of caution on, what is the correct amount. By the way, just as an aside, when you are a member of the website, there is a booklet called How to Use the Morgan Report. We actually go through that kind of psychological thinking of, hey, I'm this age, how much physical should I have, how much stock should I have, what kind of stock should I be in, should I be more in the top tier or the mid tier or the speculative section, how do I divide between silver and gold. I do an actual outline, and it isn't this is exactly what you should do, but it's thought-provoking enough that most people are very satisfied if they go through that and understand, okay. And it's basically geared it's pretty much tailor-made, or it's individually defined as far as what your risk profile is like, regardless of your age, where you're set up in a position that serves you the best. And there's nothing better than having a position, even if it goes down, that you're satisfied you made a good decision and you can sleep at night. The people that overload, and I used to get a lot of those calls, oh, I wish I read your stuff first or met you before or whatever, because, I put everything I had into this market, and now it's going against me, and I don't want to take a loss, but I have to. I've got, kids to feed or a business to run or a mortgage to make, and those kind of calls really upset me because there's no reason for that to take place, and it does take place at times.
All of those questions I could ask you during this interview, but I don't think I'm going to, because I think the best thing to do is to go directly to TheMorganReport.com and do your own research, and for our listeners to gravitate where they will and to engage themselves with you or Chris as they will. But I do have one question for you that I think I will ask, maybe a couple of questions. Can we have a gold rush, a silver rush, and a strong dollar at the same time?
Absolutely, it's possible. I mean, there's a strong argument out there, and given my colleagues, that, gold moves opposite dollar, so you make a strong case for that, but it's not always true. The idea that I've tried to put out is that when there's doubt, when there's fear, when there's uncertainty, gold fills that. It's not necessarily an inflation hedge. Professor Jastrom proved that it does better as a deflation hedge. But let's just think of it what it really is, and I'd go along with Doug Casey. It's a crisis hedge. And if you look at Martin Armstrong, and I don't want to put words in his mouth, but reading his stuff, it's sort of like governments can fail hedge. So hopefully I framed that correctly, but that's the way I read his work. So gold to me is not an inflation hedge or necessarily a deflation hedge. It's more of a crisis hedge or an uncertainty hedge. It's something that you can trust. Gold is a metal, and silver as well, but not to the level that gold is in today's society. If you go back in monetary history, you'd have a different answer, but let's just talk about the here and now. That even banks that poo-poo gold, the central banks have been net buyers of gold for several years now. Even though they hold their nose and pretend it's no good, watch what they do, not what they say. So gold's a fail-safe investment. It's something that's it's like a touchstone. It's something that's always there and it always works. It always works at the price that you want it to, or does it always give you the value you think it deserves? The answer is no. But it's something that doesn't burn up. Paper money has burned up every time we've tried this fiat experiment. We haven't had one example where it just marched on majestically like gold has. This is the idea of gold from my perspective, which means you need to have a position in it. You want to call it insurance, fine. I don't care. I think really you're better served by having a metals portfolio, which would include silver and gold as a minimum. And if you're really sophisticated, you could put in some other white metals. You could go into the stocks. You could go into ETFs or what have you. It's more than just a commodity. I had an interview with a very, very astute guy on the commodities exchange, and he says it's just a commodity. And we had a discussion around that. Neither one was like, oh, I'm right, you're wrong, or any of that. It was just like his perspective as a floor trader, a very bright guy. A lot of times in history, it is a commodity. But there's other times in history where it's like the most important commodity because it serves its function as money. And as Mike Maloney says, it does an accounting. Gold does an accounting for all of the malinvestment, misallocation of capital, bubbles, all the, let's say, mistakes in quotation marks that are in the financial system. And it rises to a level that it makes up for all of these errors. And this is what happened in 1980. In fact, if you read one of my early articles called Engineering the Price of Gold, you'll see that we actually, in the United States, could have gone back on a gold standard at $400 an ounce gold. But as we all know, gold went to about $850. So we could have actually gone back to a full gold exchange standard at that time and been solvent on a gold basis. Of course, no one was thinking in those terms except some of us nut jobs like myself. But if we had to do that again in today's dollars, I'd probably be north of 10,000 in the gold price. Regardless, this is the time where you have to really be calm, take a deep breath, evaluate for yourself, educate yourself, and determine for your best interest what serves you best. I think a gold and silver position will serve you best, especially from this point forward.
Speaking of engineering the price of gold, don't you think it's in the interest of the banks right now if they continue, and I'm just going to say it, if they continue their suppression so they can accumulate it at low prices?
Possibly. My answer to that would really be I think they've done that. I think it's done. I don't think they can really go much longer. I think they've done a great job of accumulating over the last several years, and at some point they got to let it rise. So if you look at some of the great traders in history, Jesse Livermore or even the Rothschilds, they'll sell in very, very hard and with good volume into a market to determine what the bottom is. And once that's determined, they'll go the other way because they now know, they have assurance, they have a much less risk. And I think that's where we're at in the gold and silver markets. I really think they've been washed out. I think that the bottom is in, as we said at the beginning of your show. So now is a time to continue to accumulate, and as the run continues, not add to it from their perspective, not from an investor's perspective. I'm looking at it from the, let's say, the manager's perspective. So when things start getting hot, they'll let it run. They'll just stay out, and they'll let the public and the hedge funds and the money managers and the pension funds and everyone else that's interested in the market all of a sudden just take it up and up and up and up and up, and they'll be on the sidelines. And then they'll wait to see exhaustion, which if you have all the data, it's pretty easy to determine on a volume basis when the exhaustion takes place. And then they'll add to their short positions on the paper side, and you'll see the market sell off. But that will be a sell-off from a higher point, and the low will be a higher low. So we'll be back in a bull market. So you have higher highs and higher lows, and that's the way the market will move all the way up. And then all those swings, the banks, or let's say the commercials from the commodities perspective, will be on the correct side most of the time when that takes place, if not really all of the time. Regardless, it doesn't mean that they are controlling the market to go anywhere they want. I mean, I have friends out there who say, they could put the price of silver at X at any minute they want. I disagree with that. The market forces certainly can be determined by their ability to maximize the amount of fiat that they have to move a market. There's no doubt about that. It's happening already in the S&P. I mean, the Dow was off substantially, and so is the S&P. Then all of a sudden the S&P comes up level. How did that happen? Well, it happens exactly how it happened in 1987 after the Working Group on Financial Markets was brought into the fruition, which says, how do we get out of this mess? And of course, you had some pretty savvy financial guys. So it's very easy. You got to use a lot of leverage, and all you have to do is you got to go into the futures markets and buy S&P futures, and that will bring the market up. And of course, it did it in 1987. It does it today. And so these are things that are blatant manipulation, absolutes. These are things that can be proven, and yet most of us that are, let's say, on the professional side understand it and know it takes place, but a lot of the public doesn't. And a lot of the public, if they understood it, would probably justify it. I'm not going to make it's a right or a wrong thing. I'm just going to say that this is what happens. And that was brought, again, to fruition because the powers that be, the Federal Reserve, the SEC, head of the stock exchange, head of the commodities exchange, the Treasury, all these people at very, very high levels basically pulled their talents, if you want to call them, together. They were able to help the market. And this is something that, no one wants a stock market crash. So what do? And so they have the authority to do that. Just look it up. Google Working Group on Financial Markets. Give yourself a 20-minute education on what that's all about.
It's interesting because I'm kind of thinking a number of things while you've been talking about this, that we may never see an actual stock market crash again because those forces are in play to keep that from happening. We may have even seen that during the last week. And on the other hand, unless you're a gold or silver bug and you're collecting physical gold and silver, and there's definitely profit in that right now, what does it matter how much gold or silver, physical gold or silver is available if it's a paper market anyway? You can make up the numbers as you want.
Yeah, well, there's a lot of truth in that. The idea, though, is what's been proven. I'm not so much want to be on the theoretical side of this. I want to be on the practical side of this, and that means there's only so much physical, regardless of how much paper, which is infinite. And so the market will distort, and we've already seen it happen a few times, where like even in the paper market, you see a distortion between like the spread between the S&P and the futures market and the actual S&P and the stock exchange. And when those distortions take place, then the arbiters come in. There's an arbitrage opportunity available because you're buying the same thing at different prices. So it'd be like being able to buy gold at 1,100 in one market and sell at 1,200 in the other market. And that arbitrage opportunity only is available for a short period of time because markets still are very efficient. So they will come together. The same thing happened in the physical silver market in the 2008 crisis. So these things will take place, but I'm getting long-winded. What I want to be is succinct. All manipulations over time have failed. So whatever they're manipulating, be it the stock market or the gold market, these things cannot last and will not last forever. And I know people get tired of hearing that, but it's true. And the way to tell that it's happening is, again, what I just said. I'll repeat that you'll see a larger and larger discrepancy that may not go away, where if you see like a spot price set by the LBMA recently that was like 80 cents under the spot silver price. something's wrong, and anyone awake sees that. And I did a quick update with Sean on SGT Report about that, and many others went in and talked about it as well. So these are the signs that things are breaking down, Ellis. So can they? Yeah, they'll do their best. And will they? Yes. But will they forever? No. It gets to be a point where the trust breaks down, and that's, again, where I want to come back to the dollar gold thing. I mean, everyone right now is pretty much trusting liquidity. What is real, and what can I trust? And there's been a huge move into the bond market, which is a huge mistake. You couldn't be making a greater mistake than to get into more debt when debt's the problem. But if you're super liquid, you just want dollars, very, very short term, or just park it in the bank, then that makes most people feel real safe because they're not familiar with monetary history. They're not familiar with the fact that all fiats are corrupt and that they all fail. So they feel very safe that they've sold whatever their assets are and they're in all cash. That gives them a very, very strong feeling that everything's going to be okay. So you can see cash move up or dollars move up substantially, especially the dollar index, and gold moving up at the same time because the smartest money will be moving into the ultimate currency, which is gold, or the ultimate money, I should say, gold, and everyone else is moving into the ultimate currency, which has been the U.S. dollar, although to me it looks like the dollar's starting to break down again. So that's the idea. Again, probably over-talked it, but I really want to stress that you have to be educated for yourself and determine, what happens at the end of these great things, these great inflations. What takes place? Do you go into deflation, and after you come out of deflation, what happens? What is taking place over the last decade? What's taken place since 2008? Have things really gotten better? Has there been more obfuscation of what's going on? Has the financial markets really healed? Does the stock market really project how good the economy is? Are there things in the gold market that just don't add up? What about what's going on in the silver market? Why is silver at a level that the miners cannot produce it for? I mean, these are questions people need to ask.
I imagine it's not any less expensive to mine to produce silver than it is gold, really, when you're talking about equipment.
Right. I mean, to back you up, maybe say it a little bit differently. I mean, if you're going to move a ton of rock, it doesn't matter if there's lead in it, zinc in it, copper in it, gold in it, or silver in it. If you got, for example, this is a hard rock mine, and you're moving a ton of rock, you're moving a ton of rock. So what you have to determine is, how many dollars, quote unquote, are in that ton, and is it economic to move that ton of rock, or isn't it? So yeah, you're right. I mean, the equipment and the costs, I mean, the rock doesn't care what's in it. The miner cares what's in it and cares the amount that's in it, because if it's not enough, they're not going to make a profit, and it's stupid for them to really participate in that market.
Now, I know we're going to see you in Toronto for the PDAC, the Prospectors Development Association of Canada. Why are you making the trip this time?
Well, always to keep in touch. There's great networking. There's always, meeting new people, getting that type of thing. But as you know, we have a private company called Lemuria Royalties. I can't say much on the radio, but if you look up LemuriaRoyalties.com, there's information there for the general public. And I'm meeting with, right now, and there's still more to come, 4 different prospects regarding that royalty/streaming model that we've developed. So that's the main reason.
Thanks so much for joining us today on the program.
Well, it's always a pleasure. Thank you.
I've been chatting with analyst, investor, and newsletter writer David Morgan. His website is TheMorganReport.com. Listen to this segment again on the homepage of our website, EllisMartinReport.com, and download the entire Ellis Martin Report on iTunes and TuneIn Radio.